What's going on, everybody? Welcome back to the Run the Numbers podcast. Yesterday, I engaged in one of my favorite pastimes ever. Whenever I need some time to think, I hop in the car, I head over to Dunkin' Donuts, who doesn't sponsor this podcast yet. I don't know why, because I'm talking them up all the time. Not Starbucks, Dunkin'. I'm a Dunkin' boy from Boston. I drink iced coffee even when there's snow on the ground. I wear mittens. That's how dedicated I am. But I hop in the car with my dog, Walter, our editor in chief, and we drive around. We go to the car wash with the iced coffee, and then we stop at the gas station and get some beef jerky for him. So I don't know. I just wanted to reflect on that small moment. It's our pastime. Keeps me positive. Keeps me going. So find something in your life that you can turn to when you need some time to think there. What I do want to talk about is the state of the economy and how it impacts the tech ecosystem. There's been a lot going on with tariffs, lots been written on that, but not a ton on how it impacts companies that sell stuff that you can't touch. I've made my career working at companies that work at stuff that you can't touch. I mean, it's both the beauty and horror of tech, right? That your most valuable asset goes home at the end of each day, right? You don't have inventory, so that's great. But like also they can just leave whenever they want if they get a new job. But like it still permeates throughout the tech ecosystem when something like this happens. So how does this impact tech if it only applies really to physical goods? So I mean, just like small recap here. I mean, despite economic evidence of the efficacy of tariffs dating back to I don't know, the time of Jesus Christ to grain traders on the Mesopotamian plains, the US decided to slap levies on all major trade partners. And so the result of that was a 1.8 trillion one-day loss in global equities, which was actually the worst hit since the start of COVID. And some of that has been clawed back, but there's still a ton of uncertainty in the market. And so I am someone who studies valuation multiples and how macro shockwaves ripple into tech stacks. And I'm not like an economist. I actually struggle with the whole supply demand thing. But like, let's take a look at valuation multiples, which are like a shorthand for what's valuable if you're looking at the operating profile of a company. And while it's not a direct hit to IP heavy companies who are selling stuff you can't hold, it's definitely not net good. And it caused the median SaaS multiple to contract below 5x forward revenue. So, like, for those out there who are wondering what that means, if a company is forecasted to do $1 billion in revenue over the next 12 months, their valuation would be 5 billion if it was trading at the median of 5x. It's actually a little bit under that right now. And these are levels we've only seen 3 times in the last 10 years. So that's pretty damn low. And so, based on the trends, we might see this whole as like I don't know, like a before and after type event where the state of the economy was never the same. And the day we chose to walk off a cliff. And so I was talking to an investor last week to get his take on companies that rely on global supply chains. His quote was, "Oh, yeah, like really fucked." And so even if you don't move atoms, your customers probably do. And their budgets are about to feel like they got clotheslined. And so, you know who drops a bag on ERPs? Nike. Who keeps their cloud spend cranked to 11? Lululemon. Wearing them right now. FP&A tools? Ralph Lauren. Actually, they're probably still in spreadsheets. Sorry. But we'll first see it in slower procurement cycles, then in deferred renewals, then in CFOs asking, can we just use old tool XYZ for one more quarter? And we're watching like a self-inflicted COVID-like shock ripple across all sectors, not just retail, all of it. So weird spot to be because it's not showing up in earnings yet. A lot of companies just this past week started reporting their Q1 earnings, and stuff looks decent right now. But what I want to remind people is like it's always like a non-linear unwinding, and it shows up later, especially if you're selling tech. It's not like you'll see it in your gross margin immediately if you're Nike, where your cost of goods goes up. It's a bit more delayed. So it's kind of this like hurry up and wait mindset, which is scary to many people. Oh, what is that? Oh, that's a sponsor. A sponsor? Yeah, it's Gelt for Mostly Metrics. So you already know tax season isn't just a deadline, it's a lever. At Gelt, they work with CFOs who aren't just looking to stay compliant, they're looking to unlock strategic value from their tax position. Think optimized entity structures, real-time visibility across complex ownership, and proactive tax planning that actually moves the needle on cash flow. And here's the thing, the tax landscape is changing fast, especially for high growth businesses. I'll alternative investors, and companies navigating multi-entity complexity. Whether it's preparing for a capital event, evaluating compensation structures, or just avoiding costly surprises, your tax strategy should be as agile as the rest of your business. They give you quarterly strategy check-ins and proactive estimates designed to lower your effective tax rate, protect equity value, and drive long-term efficiency, all delivered through clear communication with your Gelt CPA and a powerful modern platform. Learn if you qualify at go.joingelt.com/mostlymetrics. That's go.joingelt.com/mostlymetrics and schedule a call to learn more. So back to what I was saying, people forget how nonlinear the knock-on effects are when you mess with supply chains. It's like, don't touch the supply chains. It starts slow, then it's sudden, and then it's like, why can't I buy a desk? I'm doing this from a Pottery Barn desk that took 10 months to come when I ordered it during COVID. So almost like a full year I was working off this like beer pong table and writing from that. So I don't want to be like totally all doom and gloom here. I wrote down a couple of industries that could quietly benefit from this. So a few tech and tech-enabled players could thrive where new stuff is delayed, expensive, or just plain stuck in a port. So re-commerce platforms, the likes of Poshmark, ThreadUp, The RealReal, maintenance workflow software, ServiceTitan, Upkeep, Fix, parts discovery and procurement platforms. I worked at a company called Parts Tech where I was CFO. And so we would help garages find aftermarket car parts to fix like your brakes. So people aren't going to go out and buy a brand new car, right? They're going to keep the one they have and do maintenance to it. Refurb and reverse logistics, so Optoro and Loop, smart inventory and demand planning software. Anaplan and NetSuite could both benefit from this. So how does this all trickle down into capital markets and deal flow? What if you're raising money right now? What if you're trying to sell your company? Well, investors hate uncertainty, full stop. Why? Because it makes the inputs in their fancy DCF models less reliable. And we've injected greater anxiety into macro conditions, which that directly impacts the micro of deals getting done. And so when I worked at Parts Tech, that marketplace that enabled the sale of aftermarket car parts, my friend Perry would always say, CJ, brake pads might get delayed, but they never get denied. And he was right in that sense. Like some deals will get delayed, others will indeed get denied. Expect fewer board approvals, longer diligence cycles, and more investors asking like, well, what happens if the container rates double again? That changes things. And I think the biggest spot this will actually show up is in hiring. So I was listening to the Prof G podcast, and they were riffing on the concept of like, what happens to students that are graduating from like MBA schools, or even students that are graduating from Boston College undergrad, where I went, and they're looking to get their first job. And I think there are a lot of people who are going to get their job offers pulled this spring, which is scary to think about. When I was coming out of PwC, I had a job lined up at PwC. Well, what if PwC serves a company like Nike or Lululemon and they're like, ooh, there might be some softness here. Do we really want to spend our budget on an entry-level person? And what's scary about that is it's not like it all comes back around. Like it might get fully denied, because if PwC doesn't hire the extra 8% of people this year, it's not like they wake up a year later and say, oh, well, let's hire 16% now. No, it's probably still the same 8%. They fully denied that first 8%. I want to tell you this funny story about my neighbor that I think makes a lot of this real. So I was walking around in the driveway with Walter in between calls, and my neighbor is this former hedge fund guy. He's a real character, and he's retired now, and he's now a professor at Rutgers. And he was saying, hey, CJ, we're a Rutgers school. So our football team, our basketball team, they all wear Nike uniforms. We put those orders in 12 months ahead of time, okay? It's not like we just right before the season starts, order these. So we have contracts with Nike that have locked in this price for all these jerseys and all the swag that they're going to deliver for our team, and also for the fans who wear it, right? They have Nike on the logo there too. He's like, what's going to happen? Like something has to give here, because Nike is not in the business of losing money. I don't have Nike's numbers in front of me, but let's just say that their profit margins are 15%, 20%. Well, if the tariffs are like 100%, like they're shit out of luck there. Like that, the math doesn't math. As my buddy Brian Duffy says, that dog don't hunt. And it doesn't. So something has to give there. Like, are they going to renege on all those contracts and just say, sorry, Rutgers, no jerseys? Or like, is Rutgers going to have to pay more? Or is Nike going to figure out something on the back end with the supply chain? But like that has a huge trickle down effect. All right. So if we do think that we're going to have a recession, because what we're seeing right now is this dislocation in the market, and dislocations and recessions are not the same thing, but they can happen at the same time, right? So a dislocation is when the market is having a hard time pricing assets. It's not that the assets are necessarily like spoiled or ruined. It's that the market doesn't know how to place an appropriate price on them based on macro conditions or like an exogenous shock. So, like, I hate to say it, but sometimes you just got to keep calm and carry on. Pretty crappy advice. And it falls into the bucket of things that you can't control. But here are some things I wouldn't do. I would not hire ahead of plan. So headcount is a fixed cost that you can't unwind on like very easily. So stick to your annual roadmap unless your revenue is meaningfully outpacing it. The next thing, I wouldn't sign multi-year contracts unless the discount is substantial and you're confident in long-term usage. So I think flexibility is worth more than a 10% break if you end up pivoting. Like if you want me to sign a 3-year deal, I'm expecting a risk-adjusted return on that, and the risk is higher right now. So I'm probably not going to sign a 3-year deal unless like the discount goes from like 15% to 30%. It has to be really worth my time. Some things I would do. I would review budgets monthly, not quarterly. So I have to admit, in FP&A, there are many times where I would, supposed to meet with marketing, and we would just push to the next month. Hey, no news, no news. Don't do that. Meet with somebody, and sometimes no news is good news. So just this memorialize that you met and make people feel more comfortable. There is some solace in that. There doesn't have to be like some groundbreaking event. So don't wait till quarterly. Don't wait till 6 months to check in. Just start meeting monthly and do what you said you were going to do there. You may uncover some early signs of spend slipping or getting squeezed. That's why you should check in. And speaking of that, track pipeline exposure to non-tech customers. So I remember back in COVID, what we did is we went into the CRM and immediately filtered for any sort of opportunity that was related to either the airline or the hotel industry. And then what we did is we offered them like a safe harbor deal, we called it, where if they became a customer, we actually weren't going to charge them anything for the first like 3 to 5 months. So they got to use the product for free. And they looked at us as like a partner who said, wow, they understand what we're going through. They're giving us, it was a security tools to keep our business safe during this time. And like, they didn't have to do that. And it built some real long-term relationships. So you turn the chaos into an actual opportunity by doing that. The next thing here is over communicate with employees. So treat them like adults and be honest about what you know and what you don't, and when you think you will know. Because I think silence breeds assumptions, and the assumptions are rarely in your favor. And speaking of that, it's a really, really good time whenever something like this happens to remind people how the company makes money. You probably hear me say it all the time on the podcast, but like whenever there's a new hire, I say, hey, would it be helpful if I explain how we made money here? And regardless of what they say back, I always just explain. And that's because I think how you make money as a company, like how you bill customers, when you receive money, how you charge, how the contracts are set up. Is it subscription? Is it usage based? Can they pay with a credit card? It all permeates into everything, especially the product that you build and the expectations that you have around it. How long does a typical customer stick around? Is it like a month-to-month thing where we're betting the house on them coming back? Or is it like, hey, once we have a customer, guys, this is awesome. They stick around forever and we can sell them more stuff. You have to explain how the company makes money, because especially product managers, if they don't understand unit economics, they end up selling non-accretive features off the back of the truck, which is never good. And this is just like a PSA to everybody that silence breeds panic. So over communicate with your employees, treat them like adults. And hey, sometimes it's difficult, but if it was easy, everybody would do it. That's why we play the game. Good luck out there. Catch you next week.